Hello, successful and soon-to-be successful traders. Chris Capri, secondsguysforex.com. You are now at the third video in the risk section here. This one is on drawdowns and max risk models. So I wanted to create some guidelines for, because I get a lot of these questions, and I just said, okay, let's just start creating guidelines for people. I mean, I've said it many times in various emails and webinars and talks and things like that, but I said, okay, let's just make this a lesson, and so you can really kind of have something tangible to work with here. And I know y'all love numbers. You wouldn't be a trader if you didn't like numbers in one way or another, or at least felt like you could work with them. So the goal of this lesson really is twofold, which is to give you kind of some guidelines for max risk models that you should be using. But we're going to start with this video, and we'll get into that topic via talking about drawdowns. And really the goal of this is to give you a different perspective on drawdowns in trading, risk, and money management. So let's dive into this here. So when we think about it as a whole, capital preservation is critical. It is, if you think about it, there's no trading without capital. I've had many students tell me, yeah, I take some time off, I blew up my account, and so I need to save back up and to get back into it. And all that time that they weren't trading, they weren't getting experience in the market, they weren't getting a feedback loop, they weren't making any profit, that's for sure. And so it's a lot of time lost. It's a situation you want to avoid, blowing up your account. In fact, we don't just want to avoid that, we want to do much more than that. But capital preservation has to be a massive focus of yours. Just like in poker, there is something called pot management, where you are managing the size of the pot based on your betting and their potential response to that and how they might react to that. You know, how much you're putting in the pot is going to have an impact upon the size of the pot, whether they bet or not. If they don't bet, it's still having an impact on the size of the pot. And if they do bet, then it could double, triple, quadruple the pot, or even more. So that's called pot control. And also in tournaments, you're kind of managing stack size. Stack size is the size of your chips. And you're doing this in particular ways to, you know, make sure that you have a really strong position going into the final table. So, you know, poker players know this. Traders need to know this. Professional traders know this. Struggling traders don't. This is something you're going to have to learn. Capital preservation is critical. In fact, if you think about it, without capital, not just to trading, but in life, there's a lot of time lost when you don't have access to capital, because you have to do something just to get the capital to do the thing you want. So it's like taking a sidestep to actually get to where you want to go. So capital is critical. To really understand the nature of capital preservation, we have to first look at the defensive end of this. We have to look at understanding drawdowns. You know, so if I have a $100,000 account and I make $20,000 profit over a month or two, my account is now $120,000. Any losses from there, say over the next month, if the next month I lose dollars, then I'm in what is called a $10,000 drawdown. So from my peak equity high is what we call a drawdown. Drawdowns are whether they are while your equity curve is rising or your equity curve is falling, are crucial to understanding CP, capital preservation, and particularly psychology. And we get a hint of this first. Well, you know, I don't even have to spend time talking about why drawdowns are crucial to understand capital preservation psychology. I can just start with getting into the topic of recovery. So let's do that. Recovery is basically, let's say, again, use the same account. I have $100,000, and my first month I lose $10,000. So now I have $90,000. I need $10,000 just to get back to break even. Okay, so now let's examine this. If I have, and these are just some numbers that should kind of naturally point and reflect back to you how much psychology can come into play here. If I have a 10% drawdown on my account, I only need 11.1% to get back to break even, which isn't too much of a stretch. But watch what happens when the numbers start increasing. If I get a 15% drawdown, I now have to make 17.5% gain on my current capital to get back to break even. If I have a 20% drawdown, I need to gain 25% just to get back to break even. So actually, as this goes on, I have to get more and more and more. I have to make more than I lost just to get to break even before I can even pay myself. 25% drawdown. I need to make 33% to get back to break even. And a 50% drawdown requires 100% gain on capital to get to break even. Now, if you've ever wondered, professionals know this, but in the industry, if you've ever wondered why hedge funds close up shop so often, what happens, hedge funds, they're notorious. They have a couple good years and then all of a sudden they start losing. And if they get a far enough drawdown, 40, 50%, they know that making 100% gain on capital is very, very, very difficult to do. And so what they just say is, F it. Let's just close up shop, send everybody their money back, and we'll take a break and then we'll start a new fund. New team, new this and that, whatever. Because if I have, if I have $10 million and I've lost $5 million, I don't get a payday until I get back to 10 million plus above that. I only get paid on what I make above that. So it's going to be a long ass time before I get myself a payday. Far better just close up shop, start a new one. That's why a lot of funds don't have much longevity. They know this. And so, but if they start a new one and they make gains right off the bat, well, guess what? They can get a payday. It's far easier and a lot less work. So that's kind of like an industry, insider point there. But I want you to look at these varying levels and then ask yourself that question. At what % loss or drawdown does the psychological pressure become too much for you to recover? You know what it's like to experience your emotions, to go through a losing streak, to try and get back to break even. You know what that's like. How much of this starts compounding itself? Do you think it's just a one-to-one relationship? That if I have a 10% drawdown, I only experience, so many thoughts and psychological pressure of trying to get back to break even. And if I have a 20%, it's the exact same amount of psychological pressure and emotion and worry and doubt and fear and all that. No, it starts increasing exponentially. And eventually that crosses, as you go into drawdowns, you generally cross two thresholds. One, you cross a psychological threshold that in your mind, it becomes too much emotional, psychological torment and burden to be able to recover it. Everybody has different levels, but eventually you will cross that Rubicon to where it's like, shoot, this is too much for me to get back to break even. And so what have a lot of you done? You closed up accounts and started a new one. The point being here is that you have to become aware of how these psychological pressures will mount and increase, and that can throw off your trading. This is something you have to understand. There's another threshold you are going to cross, which is a performance threshold. If you know that it's very difficult for your strategy to make 25% in a year, then once you hit that 20% drawdown or even 25% drawdown, you're thinking, shit, unless I have a really, really good rest of the year, it's going to be hard for me to make any money. And then what does that do? That creates, in turn, psychological pressure, additional psychological pressure, which affects your performance. Because now you're thinking, shit, man, I'm just trying to get back to break even. I'm just trying to make some money on this. I'm just trying to get to profitability. Even 1% would be great at this point. The mind starts going in all kinds of different directions at this point, and it's very easy to lose focus. It's important you see these numbers and understand these numbers and then really take this question on and say, okay, where is it for me? What's my biggest run up that I've ever had? Oh, it's 25%. Okay, so I know in my mind that if I have to, or if I have a really good run, I can make 25% before I have a drawdown. Okay, how much right now do I need to get back to break even? 12%. Okay, I can do this. But what if you're in that situation, you go, how much do I have to get back to break even? You're like, I have to get 35%. Shoot, I've never done that before. the pressure mounts, the doubt increases, the emotions come in, everything starts to change. So there is a psychological threshold that you will cross and a performance threshold that you will cross. Your goal should be to manage risk, preserve your capital in such a way that it would take an extreme, very low probability event for you to ever get to that point. That should be your goal, and that should be a basis of building your max risk model. Now, some observations, because I've had the chance to observe hundreds and hundreds and hundreds of accounts from students over the years. And some of you are very gracious and, sharing with me, your account information and things like that. Not account information, but just your performance metrics. And I've noticed some patterns, which is that your goal should be to generally avoid anything greater than a 10% DD in one particular month. I mean, if you think about it, any 1 month, you could have, let's say you're just having some small losses, 1%, 0.5%, 2%, or something like that. And all of a sudden you have a 10% loss. The weight of that 1 month alone being far greater than the other months, you're going to be like, holy shit, something went wrong. But then you're going to be thinking, man, I've been losing for 4 months in a row, and then a couple percent being down 2-3%, not a big deal, but now I'm down 13%. It really magnifies things. And I noticed that profitable accounts and profitable traders who tend to avoid, these double-digit drawdown months have a much greater chance of not only recovering, but sustained profitability over time. Also, you want to avoid multiple double-digit month losses, because as soon as you cross that and have 2 months of double-digit losses or more, your likelihood of recovery goes down exponentially. Another pattern I've noticed is that once somebody gets into that kind of greater than 25-30% drawdown, you've seen the numbers. A 25% DD means you need a 33% gain just to get back to break even. So now we're talking about 33 to almost 40% gain just to get back to break even. That, for most people, is generally out of their comfort zone, out of their capacity, and out of the system that they're using. And so they start thinking about, like, man, I have to work my ass off just to get back to this. And they realize, the weight and the odds are against them. And so at that point, they just start saying, oh, F it. Let's just start increasing risk. Let's just start doing this. Let's start doing that. And then they've really gone off the train. So looking at these numbers and these general patterns I've noticed, your goal is to avoid these difficult spots. And you do this via max risk per day, per trade. Sorry, I should have put in there per trade. Max risk per trade, max risk per day, max risk per week, and max risk per month. Now, how much should you be risking per trade, per day, per week, per month? I'm glad you asked. I have a slide for that. So I've created some general guidelines, and probably in the near future, I'll do a webinar just kind of going through some numbers. There's some really cool things. I've spent some time going through some numbers, and it does a great job of kind of hammering the point home and giving a totally different perspective on it. But general guidelines here. First off, your max risk per trade at a bare minimum has to be based upon your risk of ruin. So your max risk per trade, in that point in the risk of ruin calculator where you put in percent equity, once you increase that percent equity to a point where it starts to give you a chance for the account blowing up, it goes from 0 to 1 or 2 or even 0.5%. Once you get to that, you know what your max risk per trade is while having a zero risk of ruin. Your guideline should be to overshoot that. What do I mean by that? Well, let's say at your current strategy's performance, assuming that everything maintains in a relatively stable way, that as long as you don't risk any more than 0.5% per trade or 1% per trade, you'll have a zero risk of ruin. Okay, great. Let's just say 1%. Your goal should be to overshoot that and risk less than that. Why? Because you are going to have lapses in performance. You are going to have moments of error. You're going to have losing streaks that maybe go a little bit longer than usual. So to create a buffer, you overshoot and risk less, so you never have to actually push up against that ceiling where the max risk per trade is. That's your goal. Some general numbers. For beginning traders that are just starting out and really kind of learning this method, I recommend starting off at 0.25%. Your goal in the beginning isn't building up your account and profitability. Your goal is experience, and experience in such a way that you're not letting risk kind of throw off your training process. So 0.25% is great for beginners, people that are still learning this, that, haven't done, 50 or 100 trades, haven't done more than 100 trades with one particular model. After you've kind of done that, I'd say 0.5% for people who are a little more experienced. They have a relatively stable baseline. And a stable baseline would be you're either break even or you have some degree of profitability, any degree of profitability over a 6-month period or longer. Assuming the 0.5% doesn't violate your max risk per trade and your risk of ruin, you're fine. For more advanced traders and traders who are a little more risk takers and have a little more buffer, 1% is fine. Keep in mind this does depend upon what kind of trading you're doing. If you're trading for investors, you have to scale back risk per trade. If you're trading for yourself in a prop account, you can generally increase the risk. But just understand that anytime you kind of really push up against these barriers or violate these barriers of max risk per trade and your risk of ruin, you're throwing caution to the wind, and you're stacking things against you. And that you already have enough stacked against you. You want to reduce that stack size that's against you. That's your goal. Now, in terms of max risk per day, I generally recommend no more than 5 to 6 losses in a row. Any day where you have 5 to 6 straight losses in a row, you're probably off. As you get more advanced, you can withstand more losses in a row and be able to recover. I've had a day where I lost, I think my worst intraday trading, I think I lost 9 in a row, and yet I was still able to make money on that day. But in the beginning, that's much harder for people. In the beginning, having 9 losses in a row, 10 losses in a row is generally, you're kind of freaking out. You're struggling at that point. You're wondering what's going on. You're not used to that. Just like a professional quarterback could throw, 2 or 3 interceptions in a day and still be able to pull off a win. If they have that skill set and experience and confidence, they can do that. But a beginning quarterback is going to get rattled by that. It's the same for traders. If you also look at it, max 5 to 6 losses in a row at 0.25%, what is that? That's only a 1.25% or a 1.5% drawdown for the day. So if you've lost 6 in a row at 0.25%, you're only down 1.5% of it. It's not that big a deal. It's not a big hill for you to climb back from. In terms of max risk per week, try and keep it below, within the 3 to 4% bandwidth maximum. And a max 5%. Why is that? Because if you have 2 weeks of just straight losses in a row, then you've hit your 10% per month. That means you can only trade for 2 weeks, and then you have to sit out the rest of 2 weeks. So these are kind of upper ends of the, these are kind of the ceilings in terms of risk. I generally recommend reducing this as much as possible. Max risk per month, 6 to 8%. For people who are, a little more experienced, stable baseline. If you're a beginner, a little bit less than that. For really experienced people, you can, for those of you that are making money, unless your strategy is super conservative and risk is conserved by nature, you can generally lose 10% and still be able to recover from that. I've had that before. I think my biggest drawdown to recovery in a year, in my early days, I had about 30 or 40% drawdown. I was able to recover that, but I was much more aggressive with risk back then. As I've kind of tapered off and gotten a little more conservative because I'm protecting my capital at this point, I've had 22, 24, 25% drawdowns and still been able to recover that. So, but that's me. And so avoid putting yourself in a position where you're really hitting that 10%. Because again, once you have that creates a much bigger barrier. And then if you have 2 months of that, it's much harder to come back from that. Again, don't push up against these ceilings. Give yourself some space. Try not to make it crowded in terms of risk and performance. Again, the goal is defensive. It's always capital preservation in the beginning. You don't focus on attacking, things until you really have a confidence that if you leave your base, you can always come back to it and still be okay. Don't worry about building up your account right now. Your goal is just not to lose your capital. Your goal is to, play defensive and be smart with risk. And if you're trading investors' money, if you end up going that route, you better damn well be good at capital preservation, because investors have very little tolerance for loss of capital. Remember, most investors, they have money. That's why they're investing. They're investing because they have money to invest. They have a buffer. They're not looking to lose money. They're just, they're not looking to gain massive amounts of money. Their first concern is not losing what they have, because they already have it. As long as they have that, they got possibilities. They lose that, their possibilities dwindle tremendously. So when you start trading for investors, your goal is capital preservation. And the last kind of guideline that I have here is to kind of give you an extreme situation. Your goal should be to set up, your max risk per trade week, day, week, month, and everything like that, so that you could have 25 or 30 losing trades in a row, which is the extreme end of this. But that could happen in the beginning, just like if you were starting off in archery, it could be 30, pulls of the bow before you actually hit the center target. So try and create some space for yourself, and it should be 25 to 30 losing trades in a row, so where you never really push up against that final barrier of like, okay, to recover from this is just too much. Give yourself that buffer, because you're going to have, in the beginning, you're going to have a lot more psychological and performance lapses, and that's going to create losses, and that's going to create drawdowns. Give yourself that buffer to make a lot of mistakes. You do that, and your recovery period will be much, much quicker, and the psychological toll that you'll have to overcome from that will be much smaller. So with that being said, that kind of wraps up this lesson on drawdowns and max risk models. Again, the goal of this is to really give you a perspective into capital preservation, trading, some numbers, the psychology of how drawdowns affect you, and how they can compound those thresholds that you cross in terms of performance and psychology when you hit certain levels of losses. And also to give you some basic guidelines in terms of risk models, so that you kind of know, okay, well, what do I know? What do I work with? Now you have them. This should feed you for a while. This should be more than sufficient for a long period of time. So with that being said, I hope this is really kind of provoking something in you and really kind of awakening things in your mind about risk and performance and psychology and numbers. And so you really start to take a much deeper look at this and how crucial this is to the performance of your trading and your training and your experience of this. Because you all know what it's like to have big, deep drawdowns. Many of you do. And you felt the psychology. And it's not fun. Don't bother putting yourself in that position. Be defensive so you never get in that position. So you already have enough against you. Don't make it any harder. There's no point in it. It's already hard enough. So I hope this really, forces you to look at things in a different way and really kind of expands your view in terms of risk, drawdowns, and numbers and models. I look forward to the comments and questions and the discussion on this, and I will see you inside the course.